What is the strategy to reduce income tax in the cryptocurrency market? Income tax on the cryptocurrency market can be complex as it is a relatively new area and regulations can vary by country. I will explain how it generally works in countries where taxation on cryptocurrencies is applied, such as the United States, Brazil and some others. U.S. In the United States, the Internal Revenue Service, IRS, considers cryptocurrencies to be property, which means that all transactions, including buying, selling, exchanging or mining gains, are taxable. Here are some key guidelines. Capital gains. Cryptocurrency transactions are taxed as capital gains. This means that if you buy Bitcoin, for example, and then sell it for more than what you paid, that profit is taxable. Long-term and short-term rates. In the U.S., capital gains are divided into two categories: short-term, bought and sold in less than a year, and long-term, held for more than a year. Short-term capital gains tax rates are the same as ordinary income tax rates, while long-term rates are generally lower. Mining and airdrops. Income earned through mining or airdrops, free distribution of tokens, are also taxable and must be reported as income at the time they are received. Losses. Losses can also be deducted from taxable capital gains. Short-term losses are offset with short-term gains first and then with long-term gains. The same applies to long-term losses. Mandatory reporting. Taxpayers in the U.S. are required to report all cryptocurrency transactions on their tax return using Form 8949 and Form 1040. Brazil. In Brazil, the taxation of cryptocurrencies is governed by the Federal Revenue Service. Here are some key considerations. Capital gains. Cryptocurrency transactions are taxed as capital gains. The rates are the same as for share transactions, 15% for common operations and 20% for day trade operations. Exemption for small transactions. Cryptocurrency sales transactions of up to 35,000 Brazilian reals in 1 month are exempt from income tax. Mining and forks. Amounts obtained by mining or forks must be reported as taxable income. Annual declaration. Capital gains must be declared in the annual income tax return, using the Federal Revenue Program. General considerations. It is crucial to keep detailed records of all cryptocurrency transactions for tax reporting purposes. Consulting an accountant or tax specialist can be helpful to ensure you are in compliance with local tax laws. Tax laws related to cryptocurrencies are constantly evolving, so it's important to stay up to date with the latest regulations. Income tax on the cryptocurrency market can be complex and varies by jurisdiction. It is essential to understand your country's specific tax obligations and maintain accurate records of all transactions to ensure compliance with tax laws. Thank you, guys.